Private equity is sometimes confused with venture capital. That's because both refer to firms that invest in companies and exit either by selling their investments or by holding an initial public offering, an IPO. But they're not the same thing, and there's significant differences between private equity and venture capital. They buy different types and sizes of companies. They invest different amounts of money, and they claim different percentages of equity in the companies that they invest in. Private equity is really a source of investment capital, mainly from high net worth individuals and institutional investors. So these investors buy shares of private companies, or they gain control of public companies with the intention of taking them private and ultimately delisting them from public stock exchanges. Large institutional investors dominate the private equity world, including the pension funds. The large private equity firms are also funded by groups of what we call accredited investors. Venture capital, on the other hand, is financing given to start-up companies and smaller businesses that are seen as having potential to break out and achieve massive returns. So investors providing funds are gambling that the newer company will deliver and it's not going to deteriorate and collapse. However, the trade-off is potentially above average returns if the company delivers on its potential. For newer companies or those with a shorter operating history, 2 years or less, venture capital funding is both popular and it's sometimes a necessary form of funding. This is particularly the case if the company doesn't have access to capital markets, to bank loans, or to other debt instruments. So what are the key differences between private equity and venture capital? So firstly, with private equity firms, they mostly buy mature companies that are already established. The companies may be deteriorating or failing to make the profits that they should be able to generate, so the private equity buyers will buy into them. So private equity buyers buy into these companies and they'll streamline the operations to increase their revenues. Venture capital firms, on the other hand, mostly invest in startups with high growth potential. Private equity firms, when they buy companies, often buy controlling stakes in the companies that they invest in. So as a result, the private equity firm enjoys control of that firm after the buyout. Venture capital investments usually buy less than 50% of the equity in the startups. And most venture capital firms prefer to spread out their risk and invest in many different companies. So if one startup fails, the entire fund in the venture capital firm is not affected substantially. Private equity firms, on the other hand, usually invest significant amounts in a single or few companies. They prefer to concentrate all their efforts in a fewer number of mature companies. And the chances of absolute losses from any of these big investments are a lot lower. Venture capitalists, in contrast, are investing significantly smaller amounts with the small startups. So because they're unpredictable, they want to expose themselves far less to a single entity. Just some special considerations you need to keep in mind. The sector mandate for private equity firms is also usually much wider. They're able to buy companies from multiple industries. Most venture capital firms are limited to startups in a specific sector in which they've got demonstrated expertise. This could be, for example, general technology, education technology, or fintech. Private equity firms make extensive use also of both equity and debt in their investments. With venture capital firms, most of the investment is purely in equity.